Howdy, everybody. Welcome to Liberty Call. Today is Monday, June 10th, 2024. Hope you're having a fantastical day out there in the interwebs. It's kind of gloomy here in Colorado. We had some storms come through, and whoo, if you look up the video of Castle Rock, Colorado, you will see some, high water in a bunch of places, which is unusual because we usually don't get that much rain. I mean, we do get rain, but not usually a deluge like that. So anyways, hope you had a good weekend. Got a bunch of chores done, got some weed eating and some other stuff, and a lot of fun. Anyways, all right. Well, hope you're having a good day. And if it is your first time watching the Liberty Call, if you could give me some thumbs up, a like, a share, subscribe, a follow, and press the notification bell. All right, let's go ahead and get into today's numbers. I see some green here for the domestics. Starting out with the Dow Jones, it was up 0.18%, 69 points, closed at 38,868. The S&P 500 was up 0.29%, closed at 5362. The NASDAQ up 0.35%, closed at 17,192. The VIX was up 4.34% today. It's at 1275. Canada up 0.29%, Brazil up 0.09%, and Mexico up 0.29%. Not so good over in the rest of the world. Germany was down 0.37%. The UK down 0.2%. France down 1.35%. Maybe it has something to do with their elections. The Netherlands up 0.11%. Spain down 0.42%. Italy down 0.34%. Switzerland down 1.03%. And Portugal down 0.11%. Russian exchanges both red today. The MOEX down 1.56%. The RTSI down 1.05%. And the Asian markets, most of them are closed. Let's see, the only one that was open was New Zealand, and it was down 0.53%. All right, so that is the news or the markets for today. So like I said, not so bad here. I mean, they were kind of muted, but certainly not terrible. All right, let's get over to the weekly economic update. Stocks rose last week despite conflicting stories from economic reports. The Dow Jones Industrial Average inched up 0.29%, while the S&P 500 powered ahead 1.31%. The NASDAQ led, picking up 2.38%, and internationals rose 1.29% from the week through Thursday's close. All right, all eyes on the job report. Weak manufacturing data prompted declines early in the week, reflecting investors' concerns over the economy's strength, but stocks rallied in anticipation of the jobs report on Friday. However, the market reaction was mixed, with the stronger than expected jobs report finally came. The S&P 500 touched a record high intraday before profit taking late in the session. All right, the catalyst that wasn't. The week closed with a jobs report that underscored the economy's resilience while highlighting the data's mixed nature. The 272,000 jobs added in May were higher than the 190,000 economists expected. At the same time, wages rose 4.1% from a year ago. The strong jobs report and surprise wage increase supported the narrative that the Fed may now wait longer before considering a move on interest rates. Although inflation now exceeds the central bank's 2% target, the jobs report suggests that economic growth remains powerful despite higher short-term rates. Economic data coming out this week. Today on Monday, the 3-month Treasury bill auction. Wednesday is the Consumer Price Index, the FOMC announcement, and the Fed Chair press conference, because the Fed meeting is this week on the 11th and 12th, tomorrow and Wednesday. Thursday, jobless claims, the Producer Price Index, and Fed official John Williams speaks. And Friday is consumer sentiment, and Fed official Austin Goolsbee speaks. Wow, when Austin speaks, you got to listen. He's one of Obama's guys. Just a few companies reporting earnings this week. Wednesday is Broadcom. Thursday is Adobe and Autodesk. All right, so that is everything for the weekly update. Let's jump into today's market recap. U.S. stocks higher as tech gains ahead of Fed meeting and inflation data. All right, U.S. stocks mostly rose on Monday, driven by gains in the technology sector ahead of the Federal Reserve's interest rate decision and upcoming inflation data. Apple fell nearly 2% as its annual developer conference began, where it is expected to highlight AI integrations, including updates to Siri and a potential partnership with OpenAI's ChatGPT. NVIDIA added 1% to last week's gains, benefiting from its recent 10-to-1 stock split and ongoing AI momentum. AMD dropped over 4% following a downgrade by Morgan Stanley due to various concerns. Investors are cautious before the Federal Reserve meeting on Wednesday, anticipating the central bank will keep interest rates unchanged. The focus will be on how many rate cuts officials signal for the remainder of 2024, with expectations for 2 25 basis point cuts. Let me pause here. Do you think dropping interest rates 0.5%, because that's what 2 25 basis point cuts mean, is basically going from 5.5 down to 5? Is that really going to do a whole lot for the economy? I mean, yeah, it'll make, your lending a little cheaper, but in the grand scheme of things, I mean, spending is still going up. I haven't seen a chart yet where spending has started to flatline or tip over. Granted, new reports come out all the time. So I don't see why everyone is just, jumping up and down. They're not going back to zero. So if that's what you think is going to, granted, if the economy collapses, I imagine the Fed will do that. That's their, number one, thing in their tool belt is to reach for, low or low or no interest rates. All right, let's get back into it. Citi economists now predict the Federal Reserve will begin cutting rates in September rather than July, following strong May jobs data. They foresee a total of 75 basis points in cuts this year. So they're thinking 3, with reductions in September, November, and December. Additionally, consumer price index inflation data due Wednesday is expected to show inflation remaining above the Fed's target range, influencing market sentiment ahead of Fed Chair Jerome Powell's post-meeting conference. In the financial sector, Huntington Bank shares fell more than 5%, dragging down regional banks and the broader financial sector after lowering its net interest income guidance for the year. Regions Financial, PNC Financial, and KeyCorp also saw declines around 2%. Southwest Airlines surged over 7% after reports that activist investor Elliott Investment Management acquired nearly a $2 billion stake in the airline and plans to push for changes. Well, you could push for better seats. Personally, I hate flying because the seats are just so uncomfortable. And I'm only 5'9", so I'm not a tall person. And, there's no leg room even for me. So I can't imagine being 6 foot or taller and trying to navigate the seats of an airplane. So, and maybe some better snacks. Those peanuts are gross. All right, next up from Zero Hedge, this article is titled, "Is There a Financial Crisis Bubbling Under the Surface?" And this comes from Mike Mahari of Money Metals. So let's see what he has to say. The Federal Reserve's rate hikes have sparked a financial crisis, which has been temporarily managed through bailout programs, but continues to threaten the banking system. As per the FDIC, U.S. banks are grappling with $517 billion in unrealized losses due to declining bond portfolios, exacerbated by the Fed's monetary policy tightening since 2022. These unrealized losses, a result of banks buying long-term securities during periods of low interest rates, have already caused the collapse of several banks, including Silicon Valley, Signature, and First Republic Bank back in 2023. Unrealized losses, which are unrealized losses, which are losses on paper unless assets are sold, have become critical as banks might need to liquidate these assets under pressure, leading to actual financial losses. This was the case with Silicon Valley Bank, which faced a $1.8 billion loss upon selling bonds, triggering a panic among depositors and resulting in its collapse. To address this, the Fed introduced the Bank Term Funding Program, the BTFP, allowing banks to borrow against devalued bonds at face value. Despite this, the outstanding balance of BTFP remains substantial at nearly $148 billion as of April 30th, indicating ongoing financial strain. Moreover, the commercial real estate market is deteriorating rapidly. The FDIC reports increasing delinquency rates for non-owner occupied CRE loans, now at their highest since 2013. The post-pandemic shift to remote work has reduced office space demand, causing property values to fall and straining commercial real estate companies. The impending maturity of $1.2 trillion in commercial real estate debt over the next 2 years poses a significant risk, particularly to regional and local banks, which hold the majority of these loans. While officials maintain the banking system is sound, I'll put that in quotes, the underlying issues of unrealized losses and a weakening commercial real estate market suggest that the financial sector remains precarious, akin to a Jenga tower that could collapse with one critical failure. Yeah, real estate in general, I think is actually fairly stable, especially the housing and land. But I think commercial real estate, especially in city centers, is going to get kicked in the balls something hard. So it's unfortunate, but unless you're going to find another way to repurpose those buildings. I think of like downtown Houston with all the high rises. Same thing here in Denver. What are you going to do with those buildings if no one's, using them? Why drive into an office if you don't need to? And if companies feel that they get the same amount of work done with people sitting in, in their home offices, why? All right. Got one last article here from First Trust. Brian Westbury, chief economist, his Monday Morning Outlook. And this one's titled Spotlighting Inequality. All right. So let's see what Brian has to say. As the U.S. presidential election approaches, discussions about economic inequality are intensifying. The theme has been a focal point in elections since at least 1932. The debate centers on what the federal government should do to address poverty and close the wealth gap. Well, let me stop there. I read the Constitution at least once, maybe twice, and I have not seen anything in there that specifies that it's within the purview or the jurisdiction of the federal government to deal with poverty or wealth gaps. Again, these are not federal issues. I don't even know why these politicians, they hand or hold these things out like carrots, saying, "Oh, let me dangle this in front of you. Vote for me, and I'll do this." Even though it, education, things like local crime. These are not federal issues. All right, where were we? Joe Biden proposes measures like student loan forgiveness, which I detest, and drug price caps, and again, not within the purview of the government, while Donald Trump suggests ending taxation on service workers' tips. These proposals aim to alleviate financial stress for specific groups. Again, it's pandering. The COVID-19 pandemic exacerbated inequality through massive monetary and fiscal stimulus. Asset owners benefited significantly from price inflation in stocks, bonds, real estate, and cryptocurrencies, particularly those who could work remotely. Conversely, low-income groups lacking substantial assets were disproportionately harmed by inflation, which increased the cost of essentials like food and energy more than wages. Despite a 22.3% rise in average hourly earnings since February of 2020, the Consumer Price Index increased by 20.8%, with food prices up 25.3% and energy prices up 35.6%. This disparity has stagnated living standards for those relying on wage income. Politicians advocate for raising minimum wage to help lower low-income workers, but this effectiveness is debatable, as seen in California's wage increases for restaurant workers. All you're doing when you increase the minimum wage is just make it more expensive for businesses to stay in business, and all they're going to do is raise prices, which makes everything else more expensive. Again, it's kind of like increasing the money supply 4 years ago, and these idiots in Washington and at the Fed seem to think it wasn't going to have any consequences. Well, we know what happened. All right. Unemployment remains low at 4%, but younger workers face higher joblessness. The rates for 16 to 17-year-olds and 20 to 24-year-olds have risen significantly. Additionally, the long-term educational impacts of COVID-19 lockdowns, including skill loss and increased absenteeism, have worsened inequality. Shifting to student-focused funding rather than school-focused funding is suggested to mitigate these effects. Well, how about stop the government-sponsored loans? And then, if you're expecting me to pay these off, why are you still doing them now? That should cease. Obviously, it's a failure. That'll start bringing prices down for college, because if there's no guaranteed lending, there's not going to be as many people going to school, which is going to bring the prices down. So, the problem right now is, every Tom, Dick, and Harry goes to college thinking it's the, path to success, when in reality, it's just advanced high school at this point. All right. The influx of low-skilled immigrants poses another challenge. While it benefits higher-income individuals who do not compete with these newcomers, it pressures low-income Americans who do. The pandemic highlighted these inequalities as government intervention grew, but living standards for non-asset holders stagnated. The proposed solution is to allow free market capitalism to function without interference, as this is seen as the proven method to reduce inequality. You think the government's going to do that? Nah. You think they're going to get out of the way where they can't get their little fingers in there and where they could tax all over everything? No. All right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. Doodle-doo-doo-doo. All my contact information is there. I hope everyone has a wonderful evening, and I shall talk to you all again next time. Adios.